Today I'm going to talk about taxes, in particular the shared responsibility payment. This provision was part of the healthcare reform. It requires each individual to either have health coverage, have a health coverage exemption, or make a shared responsibility payment with their tax return, or essentially what's commonly known as a tax penalty. Contrary to what many believe, there is still a tax penalty for not having health insurance for the 2017 and 2018 tax year. I'm going to talk about one particular exemption today, and I should preface what I'm going to say here, just letting you know that I am not a licensed accountant by any means. You should always consult your accountant. But this is a exemption that a lot of people actually qualify for, and this is the coverage considered unaffordable exemption. What you're looking at here is the form 8965. That is a health coverage exemption form that could be filed with somebody's taxes. So coverage considered unaffordable, this exemption can be claimed for a lot of people who have what's considered short-term health coverage or a health sharing plan. A lot of people will choose these options just because the alternative costs through the marketplace can be quite high if you're not getting a subsidy. So let's look at an example here. So a way to figure out if you're exempt from the shared responsibility payment is based on what the cheapest plan offered on the marketplace cost. So the way this exemption works, if the cheapest plan offered on the marketplace is more than 8.16% of your income, then you would be exempt from the tax penalty. So we'll go through an example here, Lancaster County, PA. So a way you can figure out pretty quickly if you qualify for this exemption is we'll just put in the ages in a family. So let's say we have two 60-year-old people, husband and wife, that make $72,000 a year. Okay, so we'll say we're married, no dependents. The first spouse is age 60, male. Second spouse, age 60, female. Okay, and then we'll enter in the income here. So the threshold for getting a subsidy for a household of two is just under 65,000. So let's say they make 72 grand. This will show the cheapest, and they go off the least expensive plan on the marketplace, whether that's a bronze or silver plan. So you can see in this particular area, the least expensive plan on the marketplace is $1,900. So to quickly calculate whether this couple would be exempt from the tax penalty would be to take their annual income, which is $72,000, multiplied 0.0816, because again we're looking at 8.16%. That would equal $5,875. Okay, so if you annualize this 1,900 number, well, that's basically just under 24,000. The 24,000 is much higher than the 5,875. So in this situation, this couple would be exempt from the shared responsibility payment. Now at tax time, when they go to do their taxes, they would file the form 8965, which is the coverage exemption form. And there's a specific type of an exemption that they would claim. Okay, there's a code. So the code for the exemption would be A for this particular unaffordable coverage exemption. You'd obviously fill out the name of the individual, that individual's social security number, the exemption type, and then under full year, this basically means that they apply for that they would qualify for the exemption for the whole year. So you can just check that off. Or obviously have your accountant do it if your accountant files your tax return. So in short, there's a lot of people that actually make a shared responsibility payment that don't have to. So you want to bring this up to your accountant, especially if they're asking you, well, do you have a 1095 form to show that you have credible coverage? A lot of times we'll bring this up to people when they want to look at alternative health plans to what's being offered on the marketplace. Okay, Hope this helps you guys.